losing track of everybody's shit, what everyone has going on in their life. And Michael Batnick's here as always. So we're going to start this with just a blitz of charts. And
is that what we're doing? We're just going to dive right into the charts?
Right. Yeah.
I thought we were talking about the Knicks.
There's
not much to talk about?
Stop. There's a lot to talk about. We're going to do that later. I've updated my thinking on that. So JC's got a chart throwdown for us. I asked you for your top 10, which means you probably sent me 15. Do I have that right?
Más o menos.
And they say inflation's not going to be an issue.
Well, the bond market says it's not an issue. That's the one that matters, right?
Fair. All right. What's the first thing we want to get into here? Because I think what you do better than anyone I know is this kind of panoramic, like, let's roll through the most important things that are going on in the market right now. So you're in charge. I'm turning the show over to you.
Yeah, so listen, for me, it's all about a weight of the evidence situation. And when people talk about the stock market, it's very easy to be like, oh, Michael, what did the Dow do today? Or what was the news of the day? Or what did the market do this week, right? We all do that.
Yes.
But it's not just the S&P 500. It's not just the Dow Jones Industrial Average or the NASDAQ 100. When we talk about the stock market, there's a lot more to that than a dozen monster companies.
There's 3,000 stocks.
At least.
Yeah.
There's 3,000 stocks in the Russell 3000.
That's right. Okay.
Exactly. So you really want to weigh the evidence because the average stock, like for example, the average stock in the NASDAQ is down 26%.
Right now?
Right now.
With the index at all-time highs.
Right.
Okay.
And then granted, there's a lot of junky stuff in the NASDAQ composite. But even if you look at the NASDAQ 100, which are, I don't know, arguably the best companies in the world.
These are all 10 billion and up stocks.
Right. At least, right?
Yeah.
So the average stock in the NASDAQ 100 is down 10%. The average stock in the New York Stock Exchange Composite is down 17%.
So what are you saying?
These are monster corrections that are taking place that if you're just focused on, hey, what did the Dow do today? Or where's the S&P? Or what did the NASDAQ do? That doesn't answer the question of how's the stock market.
I feel like when I look at this stuff all the time, especially when stocks are at an all-time high, what's the average stock in a drawdown? And it's always like 8 to 12%. This looks a bit extreme, like 16% on the NYSE. This isn't really a pushback, it's more just an observation. What's interesting is even despite these numbers, the QQEW hit an all-time high today. Yeah. So it's not just the monster stocks that are working.
JC, you're saying the average drawdown of NASDAQ stocks is 28%.
But wait, that's a composite. It's not the 100.
Correct.
Well, right.
So the 100 is 10.
But so here's this would be my question to you. Who gives a shit? Because what are even these stocks? Are these are these SPACs? That
it doesn't matter. Why don't you take that out of the equation and just look at the New York Stock Exchange at 17 or just the NASDAQ 100 at 10? The point is, forget if it's 20% or 18%. The bottom line is most stocks are not doing well. Some stocks are doing well, but most have not been. And Mike and I were talking before, the stock market peaked in February.
All right, explain. I completely disagree. So
that was when things were the best.
Okay, fine.
That is when, if you want to go over to the new highs list, that is when the new highs list in the NASDAQ peaked. That is when the advanced decline line in the NASDAQ peaked. That is when the IPO index peaked. That is when emerging markets peaked.
All right, but
that was the best things have been.
I completely agree.
Yeah.
So, but that's what you just said is right, but that doesn't mean the stock market peaked. Like you could say things look better in February, even though the averages are higher.
Stocks peaked.
Even though the averages are higher today, things look better in February. I agree with you.
Like I said, most stocks have been struggling. Some stocks are doing well.
Do you think February was a healthy market though? I thought it was a circus. Do you remember?
The first week of February was the end. It peaked in the second week of February, and it's been a deterioration ever since.
So I thought what was going on in the markets in February, as every stock was making new highs every day, was not a healthy, normal market environment. It looked ridiculous. You had IPOs coming out like for a day, opening up 100%, and then the next day going up again.
Yep.
Like, to me, I wasn't like excited about the market then. I'm not saying that there's ever like a perfect time in the market, but if that's what a peak looks like, and then the S&P can still continue to go on and make new highs, I'm like happy about that.
That was peak enthusiasm. You're right. So SPAC, the IPO SPAC and IPO both peaked in February.
And emerging markets and the NASDAQ advanced decline line. Yeah. So that what you're saying?
The meme stocks like peaked then.
It was a stealth parabolic move.
Yes.
All the things you said were all going parabolic, and that was it. And then ever since then, and then what happened was all those growth stocks peaked and they started deteriorating over a few months. And then in May, that's when the cyclicals peaked. Industrials, financials, materials, they went on to make one more new high. And then they peaked in May. And then ever since then, it's just been deterioration.
But wouldn't you say that this market is so healthy that there's so much rotation? It's like when one group starts to lag, the other one takes a baton. And like this has been one of the most incredible markets I've seen from that point of view.
Yeah, 100%. And then if you go look to you guys were making fun of me of the one with the 4 charts. So what we're seeing is actually perfectly normal, right? Year 2 of a cycle is supposed to be a messy environment.
This is a money chart. I love this.
Yeah, so this is all year 2s of cycles over the last 50 years.
So for the podcast, what do we?
Let me set this up.
All right.
You're showing 1976, 2004, 1983, and 2010. These are all the second year after the start of a new bull market.
Correct.
Okay. So now what you're saying is that year 2 historically is more of a consolidation than a continuation.
You know why this makes sense? I'm not a big seasonality believer, JC, as you know, but this to me makes perfect sense because off the lows you see that giant rip and then we've got to digest.
Right.
So to me, that makes total sense. And, it's happening again right now.
And then by the way, to your earlier point, when you were like, all this rotation is healthy, well, if we look back at history, all of those years, as messy as they were springboards to future bull markets. So year 3, 4, and 5 were
I actually think though that most people listening don't have the frame of reference to remember the year after 04, 05. But 2010, like a lot of our listeners, traded and invested through that market.
Yeah.
2011 sucked.
Yeah,
I don't think that's because it was year 3. Like I don't think that that's what we're saying. But it doesn't always work out that year 2 is a digestion year. And then we're off to the races.
But let's not also forget.
Let's remember, it was 11, 12, 13, 14. Like, it went on. Same thing in the 80s. Yeah. Same thing in 05, 06, 07 were great years. Same thing in the late 70s.
Right.
But the S&P, I'm sorry, I know you don't like this, JC, but the S&P is up 18% this year. So it is.
And it's added a lot of that since when you're saying a top.
It's up about half of what the commodities index is up.
But you're saying the market topped in February, but the S&P, I think, has added like 11 of those 18%.
Right, but let's remember what the S&P 500 is. Is the S&P 500 the market, or is it a market cap driven index in the United States of America?
So what's the real stock market to you? The New York Stock Exchange Composite and the NASDAQ Composite?
I think you need to look at a lot of things. If you want, Duncan, if you want to pull up or the EWG, the Germany and the Europe and emerging markets, if you look globally, there we go. What's happening here? So we're looking at the FTSE All-World ex-US. So this is the rest of the world outside the US. In the middle, we're looking at Germany. There's a German ETF priced in US dollars. And at the bottom, we're looking at emerging markets. And where is this hot mess of a year taking place? At exactly where they peaked 13 years ago. This is not a coincidence. Michael and I have been arguing about this for a decade about how, resistance from 10 years ago or 15 years ago shouldn't come in today.
Why does it matter?
Because there's market memory there.
But who has memory of 2008?
Maybe your cousins or your portfolio don't, but real institutions do. Michael?
Come on.
Are you kidding me? I talk to them every day.
If we think the average age of a portfolio manager is somewhere under 40 or somewhere under 50, let's be fair, right? The average age of a portfolio manager is under 50. That means 13 years ago, this person was in their mid-30s, probably as an apprentice to another portfolio manager. Those memories are not important to that person. I mean, that institutional memory that you talk about, it still relies on people actually caring about where prices were. And I just don't think they do.
Okay, but the market's proving that they do, obviously.
Why? Because we paused here, you're saying?
It's just a coincidence that they all stopped going up here?
Okay, so do we need to take out 13 years worth of overhead supply?
Look at the XLF. I didn't bring the chart with me, but look at the XLF. It peaked in 07. It got back to the exact same level in 2015. It got back to the same level in 2019 every single time it broke. And then as soon as it broke out last year, it ripped higher. So you think that's a coincidence?
It's different stocks, though.
So what?
So, well, if we're saying that there's memory in stock prices, if the stocks are different, like BlackRock now is so much more important than it was in 07 if it was even publicly traded then.
All of that isn't. Listen, I've been arguing with Barry Ritholtz about this for a decade too, and we keep going.
Good luck with that.
Well, listen, Barry, shout out Barry, loves to pick a good fight about the stock market. In the old days, back in the day, I would walk into Barry's office, or he'd walk into my office when he wanted to fight.
Screaming at each other. It was hilarious.
All good.
No, but here's my thing. So I am a big believer in supply and demand, and I think that matters a ton. But I think the reason a lot of times why supply and demand happens is because people want to get back to even, right? So there should
anchoring bias.
Yeah, so there should be supply when they finally get back to even.
And I agree with that.
My whole thing is I just don't think that anybody who bought in 07 is still holding.
Right.
So that's why I'm having trouble thinking that there's price memory there.
And it's different.
What was it from The Sandlot? You're thinking too much. Just have fun.
All right. So how much of
baseball.
How much of this is because people are waiting to get back to even, and that's why sellers show up at that price, versus enough people believe this, they look at the charts, and when we get to that old level, people just say, it's going to have trouble here at this price. It couldn't get through it.
It's the former, not the latter. You're talking about a self-fulfilling prophecy, which is just not. That's the worst of all.
People must throw that at you all the time.
Not anymore, because they know that I have good answers for it. You may have not read those answers. But the bottom line is we all have different objectives. We all have different time horizons. We all look at the data and then make different decisions based on our own personal time. The whole self-fulfilling prophecy is nonsense. The bottom line is there's an overwhelming amount of supply relative to demand at those prices in those indexes, period. And until the demand is able to absorb that supply, prices cannot progress.
So just from your read of this, does it appear to you that there's enough bullish enthusiasm at these levels to eat up the rest of that supply?
The more times that a level is tested, the higher the likelihood that it breaks. Why? Because at a certain point, anybody willing to sell at those prices will have already sold. And that's when the demand exceeds that supply and then prices can move on. That just hasn't happened yet. It happened in financials. If you look at the XLF, it took 13, 14 years, and it did. If you look at the Euro Stoxx 600, you look at all those European index bumping up against those highs, going back to 2000, and then it finally broke out. You look at gold. You think gold just stopped going up last August at the same price that it stopped going up in 2011?
So I would actually say, if you're going to convince me that the market has memory in anything, I would say it would be in gold.
Yeah, because those people don't sell.
They don't sell.
They don't sell.
Gold, Bitcoin, copper, Apple,
and they anchor to those
Microsoft,
prices.
Amazon. We could do this all day.
Yeah.
It's price, it's supply and demand. It's human emotion. Maybe cryptocurrencies didn't exist 100 years ago, but the charts look exactly the same as the charts that you're going to see in the Edwards and McGee book.
Because it's still people.
It's still people.
So that's what drew me to technical analysis. One of the first books that I read was Steve Nissan. How do you pronounce his last name?
Nissan.
His Japanese candlestick book.
Yeah.
And it makes so much sense that the market could be the fish market or the stock market.
Yeah.
It's supply and demand.
Right. Of course, like anything else.
All right, what else you got?
Right. So the bottom line is most stocks have not been doing well since February. Some stocks have.
I think you have it backwards. Sorry, I'm not trying to be a dick, but the equal,
you are.
but the equal weight Nasdaq and S&P equal weight are both at an all-time high. So most stocks are doing well, some aren't.
By the way, the equal weight S&P 500 index peaked in May with all those others and is essentially flat since then. It might be up a little bit.
It's up a little bit.
But it's essentially flat since then. The Nasdaq 100, equally weighted, is still the 100 biggest components, and the average drawdown of those particular components are down 10%. Listen, trust me, we've done the math. Most stocks are not going up. Some stocks are. So if you want to pull up the 2 to 100
What if I say who cares because the only stocks that matter are?
Yeah, some stocks are more important.
That matter to you.
No, that matter to what the averages do.
Okay, so if you are
I didn't appoint the top 6 stocks to be 40% of the Nasdaq. They just are. That's not because I said that matters. That's just. So what is that?
Nasdaq Composite.
You got side charts?
All-time high.
Right. So in other words, it's not because I think Microsoft and Apple are the most important. It's the market has decided, and I mean,
to be clear, the S&P 500 is the greatest momentum strategy ever. It buys more of the best ones and kicks out the worst ones.
Fair.
There's nothing wrong with that. And if that's the type of investor you are, we're just going to own the indexes and call it a day, that's terrific. But you're going to have pockets, like, for example, when the indexes peaked in September, they underperform the average stock for the next 6 months.
Yes.
So it goes in ebbs and flows.
If somebody says to you, how'd the market do this year so far? What's your answer? It's not 18%?
No.
Okay.
I say the market's been struggling for the majority of the year.
Up 18%, but struggling?
The S&P 500, talk about
Dude,
home
we're in
country
New
bias.
York. We're in New York.
I know, your home country bias is like oozing out of you,
course
bro.
it is.
People are asking. They don't give a shit.
People?
They don't give a shit how Spain is doing. People on the street, I don't mean professionals. Like your boy from college calls you up and he's like, hey, what's been going on with the market this year? He's not saying S&P 500.
That's not
but
what my
that's
boys
what
say.
he means.
They're like, yo, you see this pod stock? You see this Doge?
Fair.
Are you in the Doge, bro?
All right. So
my college friends are different.
So one of your boys' dads.
Fair.
I'm trying to get you to just say, when people ask how's the market doing, they don't want to hear about the fucking MSCI XUS index.
They want to know about the Dow.
To them.
They want to know about the Dow.
The Dow and maybe the S&P.
Yeah, you're right. So,
and you won't just give them markets, U.S. markets up 18%
am I the
this
type
year.
of person? You guys have known me for a long time. Am I the kind of person to just tell people what they want to hear, or am I going to tell it like it is?
JC says, somebody's like, how the market do this year? JC says,
in dollars or what?
why don't you have a seat?
How much time you got, bro?
All right, what are we looking at? What's this 2 to 100 club?
So speaking of,
I love this.
Speaking
you
of,
don't know about this?
No.
Okay.
This is super dope. This might be our sexiest scan, and we got some pretty sexy stuff. So this was inspired by our boy Linzen, and he's like, yo, JC, we got to find the next $100 billion stocks. I was like, hell yeah, we do. How do we do that? Right? So we ran a scan. So what we did was we're looking for companies that are graduating from small cap into mid cap status, right? My whole career, I've always heard that the best winners, like you talk to the old timers, they come from mid caps, right? So, but
how do we beat the mid cap?
Well, no, the problem is that the mid caps are 2 to 10 billion. But the truth is that sweet spot. What happened to mid cap inflation? We've got $1 trillion companies. Why can't we? So for me, mid caps are up to like 30, 35 billion.
Yep.
I think we could probably all agree with that, right?
Yes.
10 billion is a large
The new
cap.
threshold. The new threshold to make the S&P based on the additions this year
Is what?
Is about like 16, 17 billion.
Sounds right.
The last raft of companies.
It's actually lower than I would have thought, but sure.
Yes.
So anyway, the whole point is the reason that mid caps are so great is because you could buy it at 5 billion, it could double again, it could double again, and it's still not that big.
Agree.
That's why huge winners come out of mid caps. So if we're looking for the next $100 billion companies, we're looking for between 2 and 35 billion.
Okay.
That's that sweet spot because you can still catch a 3-bagger before it gets into 100 billion.
But so
right?
what else has to go into that screen?
So not all types of industry groups can scale like that. Like you're not going to find utilities in there, right? You're not going to find that many staples in there, right? So think about your logical names: cloud computing, solar, semis, internet, biotech. DTC, biotech, right? So those are the kinds of names. So we scan by industry group. I think there's 14 industry groups. And then we sort by new 52-week high. So we're literally finding the best stocks in that sweet spot. And then here's the thing, like any idiot can build a scan like this, unusual options activity bullshit, right? Anybody could do that. But the real magic is then going in and looking at the list and hand selecting the best opportunities, which is where the magic comes in and we do that. The robots do the easy part.
Look at Asana. So that's a chart.
Right, exactly.
How often do names come and go on this? How many names are on here? And how often do you pull names out and add new ones?
Yeah, so we run the scan every other Wednesday. So that's about right. It's probably too frequently, but we really like the scan.
You want to buy the things that have been on here the longest?
No, not necessarily. Actually, what we end up seeing a lot of times is that we buy the stocks on breakouts, for example. They hit our targets, they reset, and they show up again, and we buy them again.
So there's an art to this. This is not just, okay, here's a screen, buy them. Then you're going the next level, and you're actually looking at these charts individually.
When somebody asks JC how the stock market's doing, he shows them these charts.
No, you guys show them these charts.
Dude, these charts.
That's what you guys do.
These charts look amazing.
You're like, oh, the market's great.
These charts look amazing.
Well, by definition, this is what we're looking for.
All right, so Rockwell Automation is the number 3 name on here. Are these in any kind of order or no?
They're sorted by new highs.
Now, these have to be within a certain threshold of new highs to stay on the list?
Our list is much longer than this.
Okay.
This is just what we publish. I think it's top 20, top 30 sometimes, depending on the situation. But what we're looking for is essentially, all we're doing is creating a universe. What we're doing here is not like, rocket science.
Yeah.
We're just creating a universe.
These are just the stocks that line up with the characteristics of potential big winners. And then you want to look at them individually.
That's exactly right. We want to make it really, really hard for us to miss something.
How popular is this? Like out of all the things that you offer to people, how popular is this? It sounds like a big hedge fund, like a hedge fund type of list, because they're looking for 3 and 4 baggers.
It's popular internally, but you'd be surprised. Like our Young Aristocrats list that looks for companies that keep raising their dividends every year. That's a hot one.
That's my rap name, Young Aristocrat.
Dude, Young Aristocrat. That's dope, right?
Lil Aristocrat.
The future aristocrat. Lil Aristocrat. I like that. Lil Aristocrat. I like that.
All right. So what's the big takeaway from what's been going on the list lately? Are you seeing a lot of one particular sector?
2 things. No matter how bad the market is, there's always going to be good ones popping up here, right?
I love that.
Like, for example, we ran this scan in the beginning of the March the 10th of last year.
Okay.
And I'm just going to send you the list because it's hilarious. It's like all the greatest winners ever. Because here's what's going on. Because we're sorting by proximity to new highs, you're seeing where the relative strength is, which once the selling pressure gives up, those are going to be the leaders. Number one.
That's a FAMIism.
So you want to look. Though. So you want to look for these things. So you want to look at these things right as the market is correcting to see which ones are hanging in there.
Even if the market's going up, it doesn't matter, right?
Okay.
We want to look for that relative strength because it has that buoyancy. In the case of last March, when the market's getting slaughtered and these stocks are making new highs, Activision, Zoom, DocuSign, Regeneron, I mean, it's hilarious, the names on the list, right? Yeah. It's like, well, in hindsight, it's like, well, what a great list that was. But in real time, it was like, ooh, man, do we really need to be buying this? But the bottom line is it shows us, number one, who's leading, and number two, when the market's getting slaughtered and you're seeing accumulation and there's just overall distribution in the market, that means that institutions are taking that supply to accumulate. Right. So, like, I don't know how often you guys talk to, like, actual traders at buy-side institutions whose job it is to, like, accumulate Exxon for their mutual fund that they work for. Yeah. But like when the days are getting slaughtered, he's support. Yes. He's the one sitting there buying. They're taking that supply to be able to buy. When we talk about like DeMark, we all roll our eyes. DeMark, 1, 2, 3, 9. Like, I don't understand it. But when you are an institution.
Tom DeMark, the count.
Fine. But the point is when you have $500 billion, yeah, you need to find where that liquidity is, and you need to find where that exhaustion is, and the supply and demand is going to come in because you have to accumulate so many shares. For my Robinhood account, like, that's not necessary.
Right. If you're an institution, you have a target weighting to certain stocks in a sector, and you're out there buying.
You need liquidity.
Right.
Or selling, depending. Right.
Right. Absolutely. Okay. Yeah. What else on the chart side?
So why don't you show the gap and go in Snap?
Wait.
What? Gap and go.
Gap and go.
Gap and go.
All right.
Right? So gap and go, Edwards and McGee in the 1940s would call this a breakaway gap, right? But what I really like is when they gap above former resistance, where you wake up one day, boom, all that supply was taken care of while you were sleeping. That's as bullish it gets because your stop is the low of that period.
What's the end go? Meaning they never come into the gap.
Right. So people are like, oh, all gaps get filled. Well, breakaway gaps by definition don't. And exhaustion gaps by definition.
But you don't know that this is a breakaway gap in real time.
Right.
It looks like it on day one.
Right. It's always a potential breakaway gap. That's why your stop is the low of the period.
But by now, you could basically say this is a breakaway gap or never. You can never truly say that it'll stay
we know that
way.
now because it tripled or something. So yes, it was. But now if you go to the next one.
I predict this gap will get filled in 2040.
Maybe. Right.
Price has memory. Right. You never know. Stick around long enough, you'll see all gaps filled.
Fibonacci, here we go.
Right, so then here's your extension, and then
wait. Before we get into it, can we just set the groundwork for Fibonacci? What is Fibonacci retracements? What are we looking at here?
It's a pizza place in Midtown.
What are we looking at here, JC?
Is it?
Tell us what Fibonacci is.
No, it should be.
It should be.
So Leonardo Fibonacci de Pisa was a gentleman in the 1300s, mathematician.
Maybe you heard of him.
You may have heard of him. The Italians love to take...
Super famous.
So famous. He was like the Kardashians of their day. So, but it was actually Pingala in India in 200 BC. They came up with the same math solution for 2 completely different problems. So Fibonacci, the Italians like to take the credit, but the Indians actually discovered it. But to Fibonacci's credit, he didn't just copy Pingala. He came up with the same conclusion.
And the math is
himself.
what? Not like the specifics, but like what is it showing?
So you see it all throughout nature.
It's a ratio.
It's a ratio. You see it's the length of our fingers, the length of our bodies. You see it in our DNA. You see it in weather patterns. Like it's a natural phenomenon that we continue to see again and again and again. I get asked constantly, JC, why does Fibonacci work? I don't know why. My final answer is that I don't think that humans currently, I don't think we're smart enough to really understand why. I think maybe one day we will. But the bottom line, I look at 5,000 charts a week. Trust me, I wouldn't be wasting my time on those 5,000 charts.
So technicians use this Fibonacci ratio to get a sense of where a rally might stop or how much potential there is in a sell-off, and they extrapolate these Fibonacci levels from the current price. And that's how it's used in your discipline.
They're levels of interest.
Okay.
To quote Brian Shannon.
Right. Potential support.
But then
here's levels of interest.
But then here's the thing, though. Is there a possibility that there's some confirmation bias happening where you only remember the charts where the Fibonacci extension proved prescient, and you forget about all the times where it just wasn't relevant?
No, it's actually the opposite. Because if the market ignores...
Of course it is.
No, because seriously, if the market ignores those Fibonacci levels...
No, Josh. Actually, what you just said is the complete fucking opposite.
Well,
here's why you're an asshole. All right, I'm listening. Go.
If the shoe fits.
Okay.
If the market is ignoring those levels, that is information.
Okay.
Right? So it's not like, we throw it away. If the market because what happens a lot of times, these extension levels, if the market rips right through it, on corrections, it turns into support, right? So it might not be resistance on the way up. It could be support on the way down.
So how do you know when to start and stop? Like, where's the 0? Where's the 100?
Peaks and troughs.
Okay.
Right? So we took the peak in Snapchat. We take the bottom in Snapchat at the end of 2018. We broke out of those levels, right, at the end of last year. We extended to the first level around 44.5. We consolidated for a few weeks.
I mean,
we broke out.
This is undeniable on this particular stuff.
This is a good one.
I mean, I got 4,000 other ones I can show you to do the same shit if you really want to.
We got time. Let's go.
All right. So I got nowhere to go, bro. So then the next target was 69. It consolidated there, as you can obviously see, right?
Right.
And now we just broke out again. So $70 is your stop, 69-ish. If we're above that, you stay long. Next target is above 110. Because Josh, right? If it goes to 100, it's going to 110, baby.
So Jason, you've been doing this forever. So you look at price, you look at Fibonacci's. Are there any new? Is there any new information that you've incorporated into your analysis as the market has changed?
Well, we're going there later.
Oh, I'm going there.
You're going to go there now? Okay. I've always wondered that. Like, because you speak with a lot of conviction about your process, but there must be some elements of your process that you've had to change your mind about or adapt as markets have changed. I know it's still human beings in the end, and it's still buying and selling, fear and greed. I get that. But, like, things really do change.
Yeah.
And we have to all change whatever we do to account for the fact that the world is different.
But here's the difference. See, I have come to terms with the fact that I don't know what's going to happen next.
Right.
I don't.
Okay.
Some people think they do. Some people are. So I speak with
you have
confidence.
Conviction in the process more so than the outcomes.
I have conviction that I know that I do more work than anybody else does. Right. And I have an army of guys that are helping me do this work. So I'm confident in that. I mean, I could draw all these charts. We don't even need to.
But
give me a marker.
Is there anything that used to work really well that stopped, or anything go ahead.
Right. So my point is that because I've come to terms with the fact that I don't know what's going to happen next, the best part of that is that nobody else does either. Carl Icahn, Warren Buffett, no, it's a level playing field.
Yeah, I agree
People
with that.
are like, oh, these guys have more information. It's a level playing field. In fact, the retail investor has a much bigger advantage to the institutions because they can be more nimble. They don't have to manage $1 trillion.
They also don't have to explain why they're doing something different from what they used to do. And Buffett and Munger talk about missing out on Amazon because it just was not a, quote, Warren Buffett stock.
Right.
And they just couldn't buy it. Now they own it.
Yeah, we could change our mind in public. Like, not in public. We could change our mind to ourselves. It's harder for...
Especially if you're somebody that's like repeatedly talking about your process. There are books, The Warren Buffett Way.
Yeah.
He almost couldn't go out and buy Amazon. So like that's a good example of like a retail investor has nobody to explain anything to.
But an example of the market changing, and nobody says you have to trade YOLO meme stocks, but like would you incorporate technical analysis into that? Or would you just say, this is dumb, I don't want to play?
The meme stocks came up on our scans, actually, because so we have another scan called the Under the Hood Report, where we're looking for unusual increases in investor interest. These could be spikes in social media mentions, volume, insider transactions. For whatever reason, there are more lunatics now paying attention to. You know what inspired this? Remember the Robin tracks?
Yes.
Remember that?
Yes.
That scan inspired this scan, but
And
we widened it out.
And then they took that away.
Right, and then we built a better one.
Okay.
Right.
Okay.
And we don't just give it away for free.
So you're looking for eruptions in
interest
in a stock, and then obviously having short interest involved there is like a big.
Well,
part
that's
of
another scan, right? So those are the short squeeze lists where we're looking.
Scans on
But
scans
JC,
on
this
scans.
is a great
Because
example.
think about it, we do all this top-down work, right? And we get a lot of credit for like doing nice global macro work, but what we do is we supplement all that top-down work with all these bottoms-up scans, the 2 to 100 Club, the Aristocrats, the Little Aristocrats. We might change the name.
But-
Speaking of adapting,
Wouldn't you say this is a great example of you adapting? Is all of these new screens? You weren't doing this in the 2000s because these didn't exist, this social media stuff.
we just want to make it agreed, 100%. We get new data.
Crypto, like you're charting things that didn't exist 2 years ago.
And we have like the on-chain analysis. You want to talk about adapting?
You have one of those with you, right? You have a Cardano chart.
I do have a Cardano chart. Yeah, 100%.
So throw that up. This is an
Throw the
example of
Cardano
something
chart.
where you've had to incorporate
Throw it up.
new information.
Throw the ADA. So I'm waiting for this guy to get above 140, and then I'm YOLOing the shit out of it, right? All in.
Don't do that to him all day. Wait, what's going on with Cardano? So you don't care about the white paper. You don't care about like the whales. You're just looking purely at price. There's nothing else really here.
Yes and no.
for
I
you.
don't care about the white papers. I do care about the whales.
You care about what they're doing, not the interviews.
We get
they're
the whale
giving.
transactions.
Right. You don't care about like the interviews they're giving. You care about what their impact is on the price of the thing.
Yeah, because we get the on-chain analytics where we can see what the whales are doing with their wallets.
So I don't even know what on-chain analytics means. I'll let you explain that.
No,
but
it's
I would
very simple.
I would just say though that like your approach to crypto to me is more intellectually honest than almost everything I come across. Like crypto more so than the stock market lends itself to like piles and piles of complete and total fantasy.
Yeah.
Like just absolute bullshit.
Of course.
Whereas you're like, all right, let's assume that the market is smart and they're selecting the tokens usually that matter. And we'll leave out Dogecoin for today. Like you're
But the Doge was showing relative strength at the time. There was leadership there.
but what you're seeing is basically this thing in May of 17 or whenever that is, June of 17 peaked.
December.
Oh, with the rest
With
of the crypto
everything else.
market.
Right, yeah.
Okay. And then it spent, I guess, 3 years in the wilderness, right? And then
that's a 90+% decline, right? My God.
Well, they all did.
it's also a made up asset that has no actual value. So that 90% decline makes sense.
Right. I'm pretty sure it's worth like 30 billion.
Right.
So by no value.
Well, now it's worth 30 billion.
All right.
It's worth 30
I'd
billion.
argue that's a long stretch from no value.
It's not quite a market cap. I know we always say market cap,
It is a market cap.
but it's not a company.
Nobody says it is.
Right. So it's not really, you wouldn't call the amount of money in a commodity a market cap, would you?
Yeah, you would.
Of course.
You would?
Yeah.
And
You would-
bonds too. Bonds are 110 trillion.
So that's an asset. That's an asset
Gold,
class.
I think, is 12 trillion.
Okay. All right. So maybe you would. All right.
Yeah.
Fine. So what's going on here? It struggled as it broke above that prior level, but it's not backing down either.
It's struggling at former overhead supply, right? Where there's more supply than demand. At the same place it peaked at the end of 2017.
Okay.
So it's absorbing that supply. And I think if we're above 140, here's a close look, right? So here's a zoomed in look. So it tried to break out, failed, and now it's just hovering underneath that 140
so this
level.
is where the extensions come into play.
Yep.
Because what you're saying is this is the level where this thing has convincingly broken out.
Yep.
And that's when you want to get long.
$140. So if we're not above $140, I think you leave it alone. But $140, I'm all in.
Yeah, so that's another interesting thing about the way that you look at the markets. A lot of people were trained as investors. And so they would say, well, if I like Cardano fundamentally and it goes from $1 to 80 cents,
Yeah.
then in theory I should be even more bullish at 80 cents. Whereas you're just like, I don't want to own this under $1.40.
I can't believe it took us 40 minutes to get to this.
Well,
No, but what's
I-
hilarious is that there are no fundamentals in crypto. There are no earnings. There's no cash flow. It's not even a goddamn company, to your earlier point, right?
Correct.
Like it's just Nothing, right? Whatever it is, it doesn't matter what it is. It could be silver, it could be platinum. It doesn't actually matter. The bottom line is there's an overwhelming amount of supply relative to demand, right around $1.40. And if we're not above that, then that's the market signaling to us that demand has yet to absorb that. And then once we break out, I'm in. In the meantime, I'm not going in. I got all the time in the world, baby. I'm chilling.
Remember when they tried to meme silver?
Yes, I do remember.
Amazing. That was after
they thought that they could literally move the price of one of the oldest global commodities by pushing up an ETF.
Yeah,
that didn't work.
On a message board. That one didn't go
yet.
That one didn't go well.
Yet.
All right, so let's pivot because I wanted to get to this a lot of stuff today. Is Robinhood now a meme stock? And if so, and you want to be involved in it as an investor or a trader, does that change the way you have to interact with this thing?
Hang on, JC, before we get your answer. It was up 50% yesterday and it was down 28% today. So the answer is yes.
That makes perfect. Well, it doesn't have short interest.
Is that the definition of a meme stock?
No, it's not. So the fundamental difference between Robinhood and the others is that there's no short interest yet. Options started trading yesterday. So like we haven't had time for there to be a 20% or more short interest.
But wouldn't we all agree that there's sort of like a social short interest? Like there's just so much hate.
Yes.
It's almost like
that's a good one. That's a good one. That's a good one.
Right? Would you agree with that?
I said
on TV today, and like this went over everyone's head. This is the most meta stock I've ever seen in my life. Meta, like, remember the movie Birdman with Michael Keaton?
Yeah, it was a good movie.
It's a movie about a washed-up actor who played a superhero trying to get his acting career back in the theater. And what makes it meta is that Michael Keaton literally is like a washed-up actor who played Batman.
Dude, he was Batman.
And he ended up winning an Oscar, I think, for this.
That was a great flick. Morgan hates it. It's like that movie.
It's not
so
a good
stupid.
movie. It's not a good movie.
I thought it was a great movie.
I loved that movie.
He's great in it.
It was a film.
It was great. It was good.
You really liked it?
Yeah.
It's not
It's
satisfying, though. It feels pointless when it ends. I mean, just to me.
You're not alone in that assessment.
Who was the mother of dragons? What was her name?
Like her actress name?
Khaleesi. So Robinhood is like the Khaleesi. It's like the mother of meme stocks. And it became a meme stock.
Well, right. So the meta aspect of it is fascinating to me because basically this is the platform that people use to recklessly speculate in stocks. And now they can recklessly speculate in the platform stock itself, right? Like you don't even have to waste time trading the things on Robinhood. You could just trade Robinhood.
We've come full circle.
But why are we just grouping all investors as reckless traders?
Robinhood,
We're
YOLO
not
people.
grouping all investors. We're saying that the popularity of Robinhood is fueled by YOLO.
Well, because listen, if
you think so?
JC, the average account balance on Robinhood is $4,000. What else are you going to do with $4,000 but YOLO?
You're not going to do long-term investing with $4,000. Like you're going to trade.
Yeah.
Okay.
So, all right. I think we could agree. The user base on Robinhood is very different than the user base on Vanguard. Like I don't even think that's
fair.
Can we agree on one thing today?
Can you buy Vanguard funds through Robinhood? Is that a thing?
You get kicked off. Deletes your account.